Hi, everyone. Welcome. We will be starting in the next 5 minutes or so. We're just waiting for more people to join. In the meantime, it's very nice to have you here. Why don't you share in the chat to let us know where you're calling from and what brings you here today? Are you entrepreneurs? Are you just working on some ideas? Are you calling from London, where we're based? Are you talking from other places in Europe, Americas, Africa? We have Middle East, we have people from all over the world. So yeah, just let us know. I'm gonna start. An AI part, predictive fraud effectiveness is definitely useful. I think that's a very up and coming space. We're actually using AI for our ads as well. Okay, we already have 10 people. So yeah. Anyone else? Just let us know where you're calling from and what brings you here. Mm-hmm. Enterprise compliance platform. Oh, lovely. That's interesting, Alex. Mm. Who else would you like to share where they're calling from and what they're working on? We'll wait for a couple of minutes and then we can get started. We always wait a bit in the beginning just to make sure that everyone can join. Mm. Martin. Okay, perfect. Nice to meet you, Martin. Mhm. Okay, so I guess we can start. And more people, I guess, will join as we go along. So first of all, very nice to meet you. Still, I'm the CEO of the Tesseract Academy. Our mission is to help businesses and entrepreneurs get started with AI. We deal with the full cycle of AI, all the way from strategy to research and development and implementation. And we also run quite a few programs aimed at entrepreneurs who want to better understand how they can utilize data science and AI within their business. If you want to know more about that, just feel free to shoot me a DM or shoot me an email. And I'm very happy to have Barak today with us, who is going to talk about fundraising in what has been arguably quite challenging environment, let's say, in the last 18 to 24 months or so. So there's going to be a presentation. After the presentation, there's also going to be a Q&A. If you have any questions, please feel free to type them in the chat, and we're going to be addressing them at a Q&A session after the end of the presentation. So thank you very much, and Barak, the stage is yours.
Thank you, Stylianos, and thanks to everybody for joining. Nice to see all of you. And if I can just repeat what Stylianos has said, because it will be important. Whenever you see something that you want to ask a question about, just drop the question in the Q&A. Don't wait to the end. And then what we'll do in the end is we'll just read the feed and try and make sure we've answered everybody. It works better than sort of at the end having that awkward silence saying anybody has any questions. So without further ado, I will share my screen and I will run through the presentation I wanted to cover today. We will make that presentation available to all of you at the end of this session. Sorry, it's just that this thing it's got about 1 million markers on the screen. Zoom is putting more things on my screen than what I need. Right, so can everybody see my screen, the raising capital?
Yep.
Yes.
Great. Yeah, great. Thank you. So yeah, we all know it's been a tough market. All in all, quick. Let me just start with a quick intro. I used to work in tech in my early 20s, and I would work in tech during the day and in the nightlife economy during the night. And then I came to England for a few months, work in a coffee shop that lasted forever. And towards sort of 2016, 2017, I started working with loads of startup techs around the tech startups around the hospitality technology. And we ended up raising money to launch a few restaurants and buy a group of pubs and do a few things around the hospitality and hospitality tech sector until COVID sort of put an end to most of that. And where we are today with DR Ventures is we are an advisory that helps startups raise capital across all sectors. So we have got some hospitality tech startups that we're working with, but really we are sector and stage agnostic. We've served, I mean, almost 100 startups, I think, since we started. And right now we've got a portfolio of about 15 companies that we're trying to raise. A few of them are in the AI space. All of them are sort of tech and consumer technology or B2B technology software. So through my conversations, dozens of conversations with investors, with family offices, with funds that invest in funds, with funds that are raising funds, and with founders, I get a very sort of broad view of where the market is. And sorry to say, it's probably one of the worst we've seen since the 2008 crash. Yes, we still got funding being placed, but the demand is much greater than it was, and I will get to it. But that was just sort of a quick background about myself, and so you kind of know where I'm coming from. So really, that's just a little bit about myself. So I'm the founder of DR Ventures, like I said. We raised some money before COVID, and since COVID, we've been advising companies. And yeah, I'm also a co-founder of 3 startups. One is in stealth, the other 2 are active. And we're working actively on raising our own fund sort of next year. So hopefully we can be in the investment game and help a little bit. So what I wanted to cover today is those few bits. So number one is the market conditions, what makes them sort of unique or maybe challenging, and what opportunities there might be still to be found. The challenges specific for AI startups, and within those the conditions. Trends, general trends in AI investing, what we've seen happening, and what we're likely to see happening into 2025. Tips on how to raise capital in 2025. What investors need to hear from you, and that's specifically for AI companies. to sort of improve conviction. And last point is utilizing AI for capital raising. There are a bunch of really cool tools that can definitely boost your fundraising activities. So I'll show you some of those as well. And obviously there will be time for Q&A. Normally I find that the Q&A is more interesting than the talk. So I will try and go over the topics relatively quickly. It's being recorded and it will be shared with you. And again, if you have any questions in the end, we'll leave some time for conversation. So let's get started. So on the market conditions, I call it bull demand with a bear supply. So what I mean by bull demand is there is an explosion of startups. There are probably, we're estimating between 5 to 10 times more startups now than there were before COVID. So imagine the last 5-6 years, there are, the number of startups raising funds has 10x possibly, which means for every company that's raising fund, there are 9 more competitors right now in the space. And as you can see in the chart here, even though this sort of the money supply, the money that's been invested in the last quarter is pretty similar to the level of sort of 2020. And if you go back to 2017, it's been pretty flat. So yes, the same amount of money is being invested, but it's being divided across maybe as many as 10 times the demand, the startups that are looking for money. So we're in a bull demand. Everybody wants to be a startupist, but we're in a bear supply. Really, it's been very difficult to raise funds. So number one is demand for capital is at all-time high, and that's because, like I said, people that left their jobs before COVID didn't want to come back, and they're all entrepreneurs now. Second reason is innovation is cheap. I mean, you can plug into a no-code tool and build technology that does something relatively cheaply, relatively quickly, and you can market it on LinkedIn or with all sorts of tools relatively for free. So it's easier to be an entrepreneur now than it was 5-6 years ago, and that's what's driving some of that demand for capital. Supply, like I said, is back to 2017, 2018 levels, and it's not looking to improve greatly in the next year. Most VCs, and I will show you some data later, receive about 2,000 deals a year, which if you think about it, it's about 40 deals a week. So about 10 pitch decks a day. And some receive as many as 4,000, but most of them sort of on average, they receive 2,000 or more, which means the competition is almost, it's very difficult to break through the noise. However, only 0.5% of all the cold email deals get funded. So if you think about it, every time you go online and fill up a funding form with that fund or this fund, 90% of these forms end up in the bin the same day. Only about 9% of them get put forward to a partner, out of which another 90% gets put in the bin, and then only 1% end up in an investment committee, and really less than 0.5% gets funded. So the real route to money is through warm leads, yeah, and I think that will increase, that will be even more evident into next year. So really, if you take one thing from this slide is, yeah, I'm not saying don't waste your time on sending cold outreach, but the chances that you will raise money like that are almost zero. Warm leads is where you should focus your efforts from next year. By and large, AI has taken, so out of the funds invested in the last quarter or in the last year, AI is still taking 33% of all the funding, which is great. It means a lot of money is being pushed into that sector. But bear in mind, everybody calls themselves AI now, right? So if you've got an app for finding a local nanny, now you're saying it's AI powered. Yeah, if you've got a dog walking app, it's AI powered. If you've got a kitchen recipe app, it's AI powered. So everybody is calling their apps AI now, which means most of the deals that are being funded are AI, or 33% of that. But then again, it's a good sign. It still means people are deploying into the space. And my prediction is that conditions will remain tough in 2025. Part of what made conditions so difficult in the market were Brexit, and then the global pandemic, and then the war in Ukraine, and then the instabilities with China, and then the Labour government, the previous government in the UK, the Labour government is not doing a better job. the turbulence with the American elections. So basically, wherever you look, wherever you put your finger, there's a problem. And when interest rates are so high, running about 5%, investors have no incentive to take risk. They can just sit on their money in the bank and get 6, 7, 8% with very low risk. So as we see interest rates drop, we will see investments flow back into the market, but we don't know when that will happen. So I think conditions will remain tough into next year. Moving on to the next slide is, the question is, what's the big idea, right? So it's how AI startups can stand out in this difficult market and hopefully raise funds successfully. So the main point I wanted to cover is obviously the challenge, which you're all familiar with, of proprietary AI versus an API AI. And I'm pretty sure 95% of the companies out there are API. So what you got to think about is it takes an enormous amount of resources to develop your own proprietary AI, and maybe only a handful of companies really do that on the global level. It's much cheaper to acquire an API, and you got to balance the risks and benefits. So as an investor, when I look at a deal, I would rather invest in a proprietary startup than an API. But then again, a proprietary startup is going to cost me millions to fund, and it might not reach the market in time to make an impact. Whereas an API startup, yes, maybe it's a bit more risky in terms of how you can protect the IP, but at least I know that if I'm backing the right founders, they can be in the market in no time, and it's not going to cost me a fortune to get to revenue. So there's a definitely a balance to be struck here between, do you build your own or do you just use APIs? I think this, the way forward is to possibly use an API, but try and really protect some of your internal algorithms. The API, and also generally the way no code software building is being developed, creates a massive duplication risk. So if any of you is building any startup, there's a likelihood that another 100 people are doing exactly the same thing somewhere else in the world. So because it's become cheap, it's become easy, it's become intuitive. Even people with zero coding experience or no technical capabilities can have a conversation with ChatGPT and get a line of code, and then they ask, where should I put it? And then they say, use this, and then they stick it on there and they see it's working, and before you know it, you've got an app working. So there is a massive duplication risk when it comes to developing AI solutions now. Really difficult to ensure you're the only one doing what you do. And I go to networking events where I hear about a founder who is building an AI-powered learning tool to help corporations do staff training, or to help teachers modulate the teaching journey of a student. And they're thinking they're the only one doing that. But I'm like, just in this event, I met 5 people doing the same thing, man. So you have to be aware of what's happening in your space and be conscious of the duplication risk. At the same time, the cost of acquisition remains extremely high. So to acquire a client, whether it's a consumer or a business client, takes a huge amount of time and a lot of effort, normally a lot of money. So what you end up is with really cheap to build, really cheap to duplicate, still very expensive to penetrate the market. And these are some of the challenges that AI startups are going to be facing, I think, increasingly in 2025. Now, if you are an API startup, there's a massive downside that I'm not sure all API startups are considering. And that downside is that if you are using OpenAI or Anthropic or any of the other ones, they can switch your tap off tomorrow. So either by putting the prices up, or by reducing functionality, or by changing the way the algorithms work, you're 100% exposed. Your entire business model is exposed to somebody else's algorithms. We've seen that happen with LinkedIn. Not a lot of you know, but about 6 or 7 years ago, LinkedIn was basically a marketing platform, and there were companies that were doing LinkedIn promotions, LinkedIn marketing, making tons of money from selling, meeting appointments, setting services, and all sorts of sales services. And then I think it was October last year, so maybe we're going back a year now. LinkedIn just completely changed the algorithm. and they basically shut down a whole bunch of businesses that went from 100 to 0 in one day. So as long as you're using APIs, you are running a huge risk that your business might be shut down. Next challenge is applied versus infrastructure, right? So if you're using an applied AI startup, for example, in recruitment, you're using AI to screen CVs quicker, or in the property market, how to find the best property deal, or in investing, you run AI algorithms on finding the best foreign exchange rates. Or you are building an infrastructure AI, which is something that lies at the bottom, that is a layer deeper, that allows other AI companies to work with your infrastructure in order to build their solutions. So this will be, again, the 2 points of tension within the AI space. Money is going to flow towards infrastructure. So infrastructure companies are much more robust. They're much more resilient, and it takes them longer to get to revenue, but once they're there, they tend to stay. Yeah, and we know it from a whole bunch of companies that have raised money and built services. It's the infrastructure company that ultimately make a difference. On top of that, you can build thousands of users, and they are applied AI. The way I see it, money is going to flow towards infrastructure, and more investors are becoming savvy about the difference between the two. Generally speaking, investors are inundated. I've said it before, they're inundated with AI startups. So everybody is saying, like I said, everybody's, you're manufacturing shoes, you've got AI powered shoes design, and that creates a lot of pressure on the bandwidth. And remember, when you're reaching out to a fund, the first person who's going to look at your pitch deck is a 22-year-old student out of university with very little experience. And all they do all day is go through pitch decks and decide which one to push forward to their managing partner. So you got to think, how do I create an edge? How do I make sure that my pitch deck gets picked up and put forward, and not ended up in the bin like 90% of them? And a lot of that might be with how you phrase what you do. The word AI has sort of lost its magic, and in fact, it's probably causing more trouble now than helping. And one other question I would like you all to ask yourselves as you build your company is: is your ultimate business model providing a service? Are you serving a service or a solution, or what you're trying to do is mine data to later trade on the data? And there's a big difference, and a lot of AI companies are being set up as, yeah, I'm not profitable, or yes, I'm giving my product for free, but wait, when I got all the data of all the people who are using it, then I can monetize the data. So what I would say is, be very honest with yourselves and with your investors. If you're a data mining company and your end goal is really just to collect the health data on thousands of patients, or investment decision data on thousands of investors, or whatever you're building, or recruitment data from thousands of applicants, if your goal is to mine data, put that into your business plan. Say, that's what we're going to do. We're going to give our tools for free for 2 years, and when we reach 100,000 users a month, we're going to start selling data, industry reports, and data services. But if you're trying to sell a service and you want to get paid £20 a month, £30 a month for the SaaS element of that service, then don't tell an investor, yes, we're only selling it for £20 a month, but we're going to have loads of data in the end. It doesn't work like that. If you want to be a data company, be a data company. If you want to sell a service, make sure that service has legs to stand on in its own right. So winners and losers. Let's see who is going to, in this current market condition, who is likely to be successful in 2025. Now, what you can see here on the side is a post. Is not a post that I posted, but I've posted this article on my LinkedIn page a few days ago. Wordware, they raised 30 million seed, and I mean, according to the article, they've done it in 7 days. Now, obviously, that's been debunked since. Nobody can raise money in 7 days. Lawyers don't even sign checks that the agreement that quickly. But they raised 30 million seed very, very quickly. And that's a classic example of an infrastructure startup. So they've built a tool that helps other startups use their tool in order to develop AI applications. Yeah, so you just talk to it and you get an app done. And they raised a bunch of money, and they've got 100,000 users, and they're growing 30% month on month. Super powerful team. And so one of the things I want to highlight here is traction is king. Yeah. If you're going to raise funds, you got to show traction. And traction means how many people are willing to pay for your product, how many people are using it regularly, what's the churn looking like, what's the retention look like, what's the net growth looks like. And if you can prove a solid traction, you will raise. The second thing is moat. So how do you defend your IP? A lot of people are not aware of the term moat when it comes to fundraising, but moat is basically that trench you're digging around your castle that stops invaders from taking over your castle. And in innovation space, what that means is, how do you create a barrier between you and your competitors? One of the biggest risks for investors in early stage companies is, what if I give 3 million to those founders and they build a product that is actually successful? So they end up reaching the market, they've got 50,000 clients, they've got 5 million in revenue. And now one of the bigger players, the Oracles, the AWSs, the Microsofts even, they look at it and say, okay, those kids have paved the way. We're going to invest 20 million next year, and we're going to take over everything they've achieved. We will give their product for free. We will dominate the market, and we will bankrupt them or buy them for a penny on the dollar. So you got to think very strong. How are you protecting your IP? First, from the point of view of infringement. So can you get it patented? Can you get it listed? Can you get it, design protection, anything to stop other people from using it? But second is, how do you make sure that your company is robust moving forward? And one of the things I've seen in a innovation podcast this week is an investor said, if your SaaS company is the sum of its revenues, then you've got no company. What it means is, the moat you're building is your relations with clients, is your relations, your deep knowledge of the market, your partnerships and strategic partnerships. And those things have more value. Those things would be much more difficult for somebody else to duplicate if they try and copy from your success. So always keep one eye on building a moat while you're building a product. Second thing is validation, and I think here a Tesseract Academy can help you a lot. One is an audit trail. Is, can you actually prove that your AI does what it says it does, and that you build it in a way that is robust from an investment point of view? In the blockchain space, they've done it quite well. They've got all of these smart contract auditing companies, and they look and check if what you say you do actually happens. In AI, it's not really been fully developed. But what you need is a really good due diligence done on your AI, which you can present to your investors and say, well, we are completely different than anybody else that you've spoken to, because if we've got an audit trail and we've got a fallback, which means, what happens if OpenAI change their algorithm? What happens if they change the terms of engagement? What do you do if the market conditions change? Next point on who is going to raise money is depending what you're building. So B2B is you're building is like Canvas, right? You're building a product that other businesses are likely to use. B2G is government. So there are lots of startups now trying to sell data protection, data security, financial regulation, and all sorts of even educational technology tools directed specifically for governments. So they're not looking to sell to companies, they're looking to sell directly to government agencies. Enterprise is another category. So if your end client is a massive corporation, then you're in the enterprise sales business, which means you're not Canvas, because nobody can download your app and use it. You got to sell. You got to go through 10 layers of corporate decision making before somebody there signs the check and starts paying you. And so that's one other sort of vertical. And the last one is B2C, which is consumer, right? So do you build apps that consumers use? By and large, money has been flowing to B2G and enterprise startups. it's been almost impossible to raise money for B2C. Yeah, so if you're building a dog walking app or find a nanny app or find a local football club for my son app or whatever, it's been almost impossible to raise funds for B2C in the last years, and I don't think that will change. And part of the problem is because the pace of innovation is so quick that most clients they're leaving, they're not staying with their provider. They will pay the membership 2, 3, 4, 5 months, and then they will quit and move to somebody else. But the cost of acquiring a client is extremely high. So you're paying a lot of money to get a client to download your app and use it, but then 3, 4 months later, they ditch you. So that's a big problem for B2C. B2B is doing okay, has always been okay, as long as your market size is big enough. So if you're selling a B2B app, a software or service that is restricted in terms of its geography, you will struggle. But if you've got a B2B solution like Canvas, for example, that can be used anywhere in the world with ease, then you're lucky. Again, B2G and enterprise, they have been the winners of the last couple of years. And again, I think it will remain for 2025. Because what it means is, yes, it takes me longer to make a sale, but once I'm in, the chances that if I've sold a product to Ernst & Young or to Hewlett Packard or to General Motors, if they've already, it took me 2 years to get there, but if they're now rolling out my product, the chances that they're going to ditch me are almost zero. These companies have a procurement cycles like 1 every 5 years. So once you're there, you're there, and they always pay on time and they never go bankrupt. So the credit terms are very good. So investors are looking for companies that are building government or enterprise solutions. Next thing is agents. I think the next big word when it comes to AI is going to be agent. Can you build an agent that will replace a human being in some sort of a food chain process, improving results? So one example of it is obviously recruitment agents, which is already being built and quite prolific. So instead of having a HR, junior HR person looking over CVs all day, you get your CV put to an AI agent. They read it, they analyze it, they give it a risk factor. They then open a chatbot and they're asking you questions. Tell me about a time when you had this challenge and how you coped with it, and all sorts of stupid questions that are being asked in a normal interview. And they're analyzing the answers you're giving, and then they decide to put you through to a follow-up interview with an HR director, for example. So there are all sorts of agents being built now, from insurance providers to holiday travel agencies. And I think that this is going to be a defining sort of next step for the AI industry, is the ability to build a human-like intermediary between consumer and their service provider, or like I said, in the case of recruitment, between an applicant and the company. And the last thing is short horizon, right? Guys, normally venture capital funds are used to look at 7 to 10 years to realize an investment. They want the money much quicker. So when you're doing your business presentation or your financial modeling, you need to show extreme profit and a real exit scenario possibility within 3 years. I don't care how you do it, but if you're not going to show that your value will be incredibly higher than it is today in 3 years, you will struggle to raise. If you got your growth need to be exponential, not linear, and it needs to grow really quick. So you got to build that. If you can prove that you will grow quickly and you will multiply your value within 3 years, by X20, X30, then you will raise. So I would say these are the main points to focus when you're building your fundraising or building your company into 2025. A few points on how to raise funds. So those things have changed as well quite drastically in the last sort of year and a half. And it's just some things to do with the practices, with how you go about raising funds. So number one is, I say here, preparation is key. Yeah. So before you even speak to the first investor, make sure your pitch deck is done properly, and make sure you've got a 1-page teaser done properly, and make sure your financial model is done properly. Make sure all your media is placed. If you've got a website, if you've got a couple of newsletters that wrote about you, if you've got people who you can get them to write a referral on you on LinkedIn to say, hey, I've used those guys and they're brilliant. Like, try and get everything you need well in advance of the raise. Due diligence, audit trail, everything you can do do before you even start speaking to the first investor. Yeah, they call it data room. Data room is a big thing, but it's really a term from private equity deals for a much later stage. But in your terms, or in a startup terms, it could be a Google Drive folder where you have contracts, pitch deck, financials, references, certificates. You just put all your documents in a nice folder, and you can share it with a client, with an investor when they ask for it. So get ready, be ready. Next, warm intros is what's going to win you the game. Okay, so if before you needed to send, if you sent 4,000 cold emails or 2,000 emails and 2,000 LinkedIn messages, you will raise the fund. Today, it's not going to work. So spend all of this energy instead of sending thousands and thousands of cold emails on getting warm intros. But you need to think, how do I get them, right? Because the dynamic of acquiring a warm intro is completely different to the dynamic of a cold email. Sometimes a cold email leads to a warm intro. It depends how you phrase it. So when you reach out to an expert, you want to say, I'm building something and I would really appreciate your expertise or your take on it before we go into a fundraiser. So you're not telling me a fundraiser. You say, I just want your opinion. He's an investor, but you're not asking for money, you're asking for advice. They tend to be more amenable to that. You get on a call, and then maybe if you charm them, if they like you, they will say, I got a couple of people I can introduce to you who might be able to invest. That's one way. Second is obviously going to networking events. Yeah, we're post-COVID now. Nobody wants to Zoom. Nobody wants to invest from Zoom anymore. If you can actually be in the events, it's worth $1 million, really. And I see founders all day, and the founders that go to events raise money. Next thing is it's better to get scouted. So I have a slide on it in the next slide is talking about it. So I will leave that to the next slide. I will explain this later. Advisories, like DR Ventures, are going to play a growing part. So your ability as a founder to build a company, deal with the technical challenges, put a team together, sell it, deal with the debugging of the product, and raise capital successfully is very, let's say it's almost impossible that you're able to do all of those things simultaneously. And because warm intros is what's going to make a difference, you can't just send 1,000 free LinkedIn messages or use a LinkedIn bot anymore to raise funds. You need somebody who's able to open those doors for you. I'm not selling DR Ventures here. I mean, we tend to come in at a slightly later stage when you raise $1 million or more, but there are many advisors out there. Of course, you have to validate them, but I would say try always use an advisory. It will that will make a big difference in raising funds. Revenue, achieve revenue quickly and maintain unit economics. Okay, that age when somebody said, yeah, we're just going to invest, raise money until we're a multi-billion company, those days are gone, and hopefully forever. So what you need to focus on is, can I get to revenue quickly? And even if you've got an MVP, even if you have a very basic product, but you can put it in the market. You can charge 1 penny or £5 for it, or do a 3 months free and then £1 a month. As long as you can get revenue, so you're proving to an investor that people are willing to pay money for this product, even at a very basic level. And then try and maintain your unit economics. So try and say, okay, it cost me £6 to deliver. Yes, I'm selling it for £2 now, so I'm losing £4 every time somebody is using my product. But after the fundraising, I'm going to put the price up to £9. Or when we launch the next version of it, we're going to put the price up to £9. At which point we will be £3 profitable from every click. So you got to know your unit economics from the start, and you got to strive really to revenue as soon as you can. You don't need a huge team, right? So I hear founders who are telling me, I'm raising 300,000 because I need to hire a CTO and a sales manager. And I'm like, what? You're going to spend £200,000 on 2 people, and that's your entire raise? It's crazy. Yeah, you don't need a large team. And if you want to bring people on, bring the people on with equity or share options. But make sure that the money you raise is being used for building a product and going to market, and stay lean until you're a very large company. Always raise. That's a mindset. Okay, I would say if you're building your yearly plan and you say, I'm going to do a development, recruitment, sales, debugging, development, recruitment, sales, debugging, into that sort of yearly sequence. Put fundraising, 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 fundraising. And even if it means that you go to one fundraising event a month, or you pick up some investor calls, or you go to meet some VCs, and you tell them, look, guys, I'm not raising money now, but I just want to build the relationship. So next year, when we reach that £1 million revenue goal, I know you, and we can start a conversation. Do that. You have to always have one hat out of all the hats of a CEO or a founder. Fundraising. You cannot just go to raise funds when you run out of money or when you got 6 months left. You have to always be in a fundraising mode. And last thing is know the space, follow investors. So there are many publications or sort of newsletters out there, venture capital newsletters and investment newsletters, that tell you when a fund is just closed, or when an investment was just made. And it's really important to track these. And I said here to tell you my example of CCV. So CCV is a fund that's called Creative Capital. Yeah, you can see them here. And you see they've just closed a fund a couple of weeks ago, an 18 million fund. And because they're investing in creative, and I've got clients in the creative space, the moment I got that in my feed, I straight away found one of the founders of the fund, and I sent him an email and I said, hey, buddy, congratulations for raising the funds. You must be looking to deploy. Can we have a conversation? I've got some brilliant companies to talk to you about. And I was on the phone to him within a week. And not only is he looking now at some of my clients, he also asked me to help him close, so help him raise funds for the fund for the future rounds. So basically, you're cementing relations with venture capital funds at the right moment. But the way to do it is by following those newsletters and keeping your ear to the ground and knowing what's happening. There's no point sending a message to a VC or an investor that raised money in 2022 because that fund hasn't got any money left. But you want to know who just raised money in your space and go and attack them straight away. So, okay, so these are the sort of tips, if you like, for raising money into the next year. So what investors need. So again, we said preparation is key, and I'm just going to give you a quick overview of the kind of profile of a company that is likely to raise fund in 2025, or the kind of stories that investors will want to hear from you in 2025. So as you're building your narrative, your storytelling, your company, try and make sure you're ticking these boxes. So number one is product market fit. Yeah, product market fit means revenue. We spoke about it. What you want to make sure is that you're telling the investor that what you're building, people already want. Okay, it's 100% important. Second thing is you can write a shorter pitch deck. Yeah. So going back to that story about WordWave that raised 30 million in 7 days, they never had a pitch deck. They said they had one page, and they just said, this is how many users we had 6 months ago. This is how many users we have now, and a chart that says, this is our growth, and this is the size of the market, and this is the revenue we have, and invest in us. So, you got to pick your narrative. I'm not saying don't use a pitch deck. I like pitch decks, and I think a pitch deck is really important. But you can use shorter pitch decks. Yeah, 8 slides, 10 slides. Maximum maybe 15. Focus on traction. Focus on product market fit. Focus on your narrative. AI validation and robustness. So again, you just need to drive it straight from the beginning to the investor that your AI is different. You're not just one more dog walking app and I'm sorry if anybody here is developing a dog walking app, an AI-powered dog walking app, but you gotta make sure from the beginning that you've done the right due diligence and analytics on your product. Next is a scalable product, global market. Yeah, so you got to think what you're building now can be easily scaled. Yeah, and it affects a global market. So if you're building something that is only relevant in the UK or in China or in France or in North America, it's not big enough. You got to find a problem that is that big that you can scale it to the whole world when the time comes. Again, team paid in equity. So that little thing here on the right basically shows that out of all the startups that are raising funds, yeah, the ones with 2 founders, or let's say call it 2 co-founders, yeah, and 3 co-founders are the ones that are raising most successfully. So if you're alone, So 25% of all the startups have one founder. Only 18% are represented in the first investment round, and only 12% of those turns into unicorns. So there's a 50% chance, it's not a chance, it's just a ratio of how they're prevalent in the market space. It drops by 50% into unicorns. But as you can see, with two founders, you basically go 35, 34, 33. So it's very consistent. And in three founders, it actually improves. It goes 22, 25, 27. Yeah. So what investors will be looking for is, can you prove that you are able to work in a team? Yeah. They don't like solo founders. They prefer to see that you're one of a team of 2 or 3. And paid with equity. So try not to take 3 CEO salaries on day one, but if you put a team together that are fully vested and they've got shares in the business, that's what investors are looking to see. The next thing is ESG. So that stands for what? Environmental ESG, not EGS.
Environment, social, and governance.
Social governance, yes, thank you. And SDG, which is Sustainable Development Goals. So both are sort of UN initiatives for positive impact. Whether you are personally believing in it or not, whether you think your startup has an impact or not, 95% of all VC funds must deploy money into ESG and SD and Sustainable Development Goals startups. So make sure there is one slide in your deck that says, this is the impact we're going to have. We're going to reduce prices to underprivileged families. We're going to reduce waste. We're going to improve the cost of recycling. Whatever that is, yeah. Even if you're building an AI-powered dog walking app, and you can have an impact a slide added to it, it's really important, because it's almost impossible to raise money without that, whether you sort of subscribe to this or not. And the last thing is exit prospects. So startups that raise funds are the ones that say, I already know who's going to buy me. Yeah. So yes, I'm only a small player now in the education space, but I already spoke to a private equity fund in the education space, and they said that when we hit a 50 million valuation, they want to buy us. And I'm meeting those people every other month for coffee, and they're really interested. When you tell that VC that so imagine the way you structure with your company is, you raise money from angels, then you raise money from VCs, then you raise money from private equity companies, then you IPO. Now, if you tell the VC that you already know the person who is going to buy your company from them in 3 years, then you've closed the loop for them. Yeah, because they know they don't have to worry about an exit. You've already taken care of that for them. So always keep one eye into the later stage people, and try and see if you can find corporations, companies in your space that are massive. Yeah, I know a company that's building medical devices, and they already have conversation with GE, which is the largest medical device manufacturer in the world, about acquiring them when they hit a certain volume. So if you go to a VC and say, GE is already going to buy me from you, when you hit that milestone, it makes it much easier to the VC to invest in you. So these are the points I would say you want to focus on within your narrative. Next thing is AI for AI, but just before I get there, because I think I'm slightly ahead of time, and let me just go back, because there was a point that I said I will cover, and I'm not sure I did. If somebody remembers, you can tell me. If not, I will probably have to go back on my notes and
Barak,
and
it
just
was
come
about it's better to get scouted, I think.
right. Yes. So I thought I had a chart on this, but yeah, sorry, I have. Thank you, Ferry. Really good you jumping in. So guys, this is a pitch deck from a VC fund. The VC fund is called 7%. It's a UK VC fund. They are now raising their third fund. And I'm not going to show you all of their pitch deck because it's proprietary information, but I chose the 2 slides that you need to know. So look at this here. On the left-hand side, sorry, on the right-hand side, focus on the right-hand side of the screen here. On the right-hand side is, where do they get their deals from? Okay. And you can see that 78% of their deals come from web submissions. Yeah. And then you also have direct mail, which is another 1%. And then you've got brokers, which is another 1 or 2%, okay, etc. So let's just say that 80% of all of their deal flow, or over 80%, comes from what you call cold outreach, web submissions and direct email and media intermediaries like brokers. Now, flip over here and see the source of the portfolio. So these are the companies they end up investing in. Web form submissions, stands for less than 7%. Okay, cold email is not even existing here. So basically, if you're sending a cold email to a VC fund, you're not going to get funded. If you're filling up a form, they get 80% of their deals come from forms, but only 7% of them end up being invested in. So really, what I'm saying is, the chances that you're going to raise money by submitting a cold form the data is that it's almost impossible. But look at that 22% here. Now look at that 22% here. It's called outbound. So this is when the VC reaches out to the founder, say, hey, we've been following you. We can see you're moving and shaking the industry, and we would like to invest in you in your next round. They do this all the time. So VCs have teams of scouts within the VC, and sometimes they pay external scouts to look at the market and figure out and reach out to founders before they even start a fundraise. Build relationships. So if you look here, in terms of source of deals, top of the funnel, what is it? 3%? 3% of their inbound comes from scouts. That translates into 22% of their investments. So basically, if they reached out to you, they're going to invest in you. And the other, by the way, is VC co-investment referral. So this is still internal work, and their own network. So if you add up their network, which is 25%, their own outreach and scouting, which is 22%, and their own VC friends, which is 21%, and venture partners, which is 10%, you can basically see that almost 80% of deals that VCs make, they come from through people they know. And that's why I said that it's much better to be scouted than to be sending a cold out mail. And again, you can see it here. This is how they process the 2,000 startups that apply for them. Okay, so you see at the immediate point of contact, they reject over 80%. And then they pass 18% to a junior analyst at this point here. They reject another 7%, about 9% gets pushed on to a team discussion, and then also 9.5%, and only 1.3% makes it to an IC, and IC is an investment committee. An investment committee still doesn't invest in all the startups. So what you want to make sure is, how do I not get rejected on all of these three funds? How do I make it to an investment committee? And the way to do it is to get scouted and to be internally referred. That's why I say advisories and building your own relations is extremely important and much better than cold emails. You can see that cold emails don't work. Thanks, Ferry, for reminding me that. So now that we're back on track with the time, let's just talk about AI for AI. You can use AI for AI, and I use it for myself and I use it for my clients exceptionally well to raise money. When I say invest in your prompts, I developed a sort of a 2.5-page long prompt that when I push a pitch deck on one side of that prompt, I get a list of qualified investors on the other side of it, straight from ChatGPT or Claude AI, by the way. Claude is less. They don't have the same research capabilities, real-time research capabilities, but OpenAI is insane. ChatGPT is insane. So invest in your prompts. That's number one. That will also help you find relevant investors. And I would say you don't have to pay anybody almost if you know how to write a proper prompt. Now, compile blurb. So again, you can use the prompt to compile a blurb and be smart about it. So what you tell the ChatGPT is, you're like, look, I found this fund. By the way, guys, try it. Go to any VC fund, whatever, Foresight group, for example. Go to any VC fund. Go to the team page, whenever you find it, about us, our team, right? Go to the team page, copy that team page into ChatGPT and say, out of all the partners, can you find the one partner that is most relevant for my pitch deck, and put your pitch deck on. And ChatGPT will basically read through their resume and experience and what they like investing in. and you see this guy is equity lead sustainability, whatever, lady, sorry. So, and they will recommend the kind of partners you want to reach out to. Foresight is a huge fund. They've got like 60 odd people working for them. So you don't want to be reaching to the wrong person and ending up in the bin. So use that with ChatGPT to tell you who to reach out to in the fund, not just how to find the fund, and then compile a blurb. So tell ChatGPT, I want to write a personal email to Charlotte, so she will look at my pitch deck. And then ChatGPT is going to look at her LinkedIn profile and at her page within the fund and say, okay, she did horse riding and she went to that university, and you are building something, and that's how you should write the blurb to her when you send her an email. You can use AI to do all of that for you now, which saves you a ton of time, and also far improves your chances of getting a response. Prepare professional IM. So right now, here in DIA Ventures, we prepare an IM, which is an investment memorandum, for all of our clients at the point of contact. And again, we feed the pitch deck on one side of ChatGPT, we give him a very long prompt, and we get an incredibly useful IM, which again, you can share with funds. Smart CRMs. I mean, we're using Zoho, we're using HubSpot. I wouldn't use Folk. I wouldn't use any of the ones that are more call them new, because they're not good. But you have to use a smart CRM that when you reach out to, it tells you straight away if they opened your email, if they read it, if they clicked the link. And also you can put a reminder for yourself to follow up in 3 days, etc. You can even automate some of those follow-up activities. Second is you want to use a note taker. Okay, so Fathom is by far the best note taker out there in terms of structuring narratives. So it's not just going to copy paste what you said. It's going to build your meeting summary into a narrative. The investor gets it automatically. So if you had a video call with an investor, Fathom was recording. The investor is getting the meeting summary automatically, which then you can follow on and say, hey, I hope you got the summary and you found it useful. By the way, as discussed, here is ABC that you asked me to do. So extremely, extremely useful. Plus, you forget. You think you remember, but after 18 weeks of fundraising and you've spoken to 60 funds, you don't remember who said to you what when. So you go back to Fathom, you quickly find the last minutes of the conversation, and you can use that. Other extremely useful tools. Brieflink. I don't know if you guys are using Brieflink, but it's insane, if you don't. Brieflink is basically a link for you to load your pitch deck on. It's completely free. And what you do is you create you do a deck plus data. I'm using deck only because I've got multiple clients, but in your case, you do deck plus data. So you're building your company profile. What it allows you to do is, like in the example here of Andy from Future Farm. Sorry, here. No, this one here. Andy from Everybody Counts. Each time an investor opens your email, you see their email, you see how long they spent on your pitch deck, and you can also see what pages they spend the most time on. So you can follow up and say, hey, Karen from Ventures Together, I can see you had a quick look at my pitch deck. Should we do a follow-up call, or what are your initial thoughts on it? So now, but also if you're using Brieflink, let's just look at this here, for example, preview. So that's when an investor looks at your pitch deck, he is going to view it within the browser, and it works well within a phone and on the desktop. But what it means is, as you're updating your pitch deck, you don't have to keep resending PDFs to people. You just change the version of the PDF that is attached to the link, and then it's seamless. Any investor who opens the link at that time, they're going to get the real-time pitch deck. And again, Calendly is no big news, no news. But I mean, if you can manage calendar slots well, so imagine that you build a smart pitch deck, you reach out to the right partner with the right blurb, with professional documentation. You know that they've opened your thingies. You've sent them a meeting summary after the call. You know when they read your pitch deck, and you know they can book a call with you automatically. You've just done a job. You built a process that private equity or investment banking people used to charge thousands of pounds to do. And you can do all of that using AI tools these days. Yeah. And obviously pitch deck writing. Yeah, so you can write your thoughts into ChatGPT. Yeah, you can just say, look, I'm building a company that's doing AI-powered dog walking app, finding dog walkers within 2 miles radius according to the type of my dog, and you say, can you craft for me a problem solution slide out of this vision? And ChatGPT is going to craft for you a problem solution slide. Can you give me a market analysis on my market? Give me the TAM, SAM, and SOM of how many dog walkers are in the UK, how many dog owners are in the UK, you know, and what the size of the market is. ChatGPT is going to do it for you. So you can literally write your pitch deck with ChatGPT's help. Okay, so there are many tools available there, and I strongly recommend. It goes back to my preparation slide. Before you start fundraising, make sure you've got all the tools aligned. Everything is there, is ready, and believe me, yeah, that's going to make a difference between those who raise and those who are not or do not. So that was it. I hope it wasn't too quick. Yeah, I'm going to stop sharing now, and we'll take questions.
Perfect. Thank you, Barak. That was very insightful. I think we might be running slightly over time, but that's fine. Are there any questions?
Yeah, I think we've got some questions. Let's go over the Q&A and see what we have. How do you have a short horizon exit when dealing with enterprises? Correct. Yeah, it's a good question. Yeah. So from Alex. So again, one way of doing that is speaking to the private equity companies already and just say, look, start building those relationships with the late stage acquirers and say, yes, we're very early stage. Yes, it's going to take us 2 years to make the first sale. But is this the kind of things you guys are buying at later stage? And if they're saying yes, then you've got a conversation going. It's just about building those relations. And also, I'm sorry, I know it's difficult, but that's what you got to do. I mean, if you walk into a VC and you're saying to them, I don't know how long it's going to take me to make a sale, you know, you're not going to raise money. So, you know, I wish it was a different market, but I'm just telling you how the market's going to behave. And if you cannot show them that within 3 years you've completely accelerated your value, chances you will raise are very, very narrow. Yeah, and then actually we don't have more Q&A. The rest were just reminders, I think, of the time, unless I missed somebody. But yeah, I'm open if anybody has more questions.
I don't have a question. I just wanted to say thank you so much. This was incredibly helpful. So thank you for putting those slides together and taking the time to run through them with us.
It's a pleasure. And yeah, and good luck with fundraising, really.
Thank you.
Yeah, no problem. Thank you.
Perfect. So if there are no more questions, I think we can wrap up here. So pretty much on time. Feel free to visit our website to learn and subscribe to our newsletter to learn about upcoming events. And also feel free to reach to us directly. I don't know if you also want to share your details, Barak, in the chat, like your website, so people can learn where they can.
Easy to find me.
Okay.
Yeah, yeah, but I'll put it here anyway. Yeah, guys, connect on LinkedIn. You know, we can keep the conversation going.
I also wanted to say thank you. It's very informative, for me, particularly the second half of your talk. I'd like to know, you know, I understood what you went through in terms of a lot of the framework that you were detailing here, and as you know, as part of going through the startup cycle, I've been through a lot of these things. What I'd like to know is, you know, how can we interact, or what kind of services or interaction does your group offer to founders like myself? Like, how can I, you know, what do I get working with?
Okay, it's a very good question, and I'll try not to make it a sales pitch. So I'll do it short, and then I'll let everybody else reach out to me if they want. But one thing I always say when I get on a call, all right, no problem. Yeah. No problem. Stay down. See you later. One thing I always tell founders when I meet them for the first time is you have to do your own due diligence. Yes, there are platforms out there that as an advisor or as an investor, I cannot buy my way in. The only way for me to be listed on these platforms is if they identified me, they've done their research, and they listed me. Yeah, one of them is OpenVC, another one is PitchBook, Signal, NFX, and Traction. So like when somebody rang me and said, Barak, you've got a PitchBook page, I'm like, I didn't know I have a PitchBook page. So you cannot be paid to be there. So if somebody reaches out to you, an agency or an advisor, just go, just validate them there. Second thing is, what we do is very, it's a whole structure depending how much money you raise. From the top, it's a co-investment advisory. So we will build your documentation, build the investment strategy, reach out to investors and sort of try and facilitate introductions and use all sorts of tools and CRMs and stuff to raise the money. And then we take a portion of our success fee and reinvest it with your company. So we call it a co-investment advisory. Anything below that, we can help you build your own investor CRM. We can populate it with data. We can give you the templates. We do coaching. We're very good at building financial models and building pitch decks. But these are like standalone services. I need a pitch deck or I need a financial model, etc. Yeah, but basically that's how we work. And we have a network of partners that, if I'm not the right one for you, we might be able to find for you the kind of people who are more suitable for you.
And these services that you offer, these are fee-based services, or are they equity?
Most of them are fee. On the advisory, there is a small success fee on top of the fee. But obviously, if we're going to build a pitch deck or a CRM, it's just a price, it's a product.
Thank you.
But no problem. But I mean, you can find everything is online, so everything is clear. But I'm more than happy to take calls after this if anybody is interested.
Thank you.
No problem. It's a pleasure. I think everyone's left us now. So Ferry is still here. Ferry is the standby moderator. So Ferry, do you want to take it from here?
Yeah, thank you so much, and thank you for those the diehards that stuck with you, Barak. I thought it was fantastic, very informative, and just straight to what the situation is for a lot of companies. So if there are no more questions, the only thing I would say is I think the ability to ask for help, whatever whatever your concerns or what you try to achieve, Barak, myself, and Stelios are there. We're always trying to help fellow entrepreneurs or corporate entrepreneurs, social entrepreneurs, trying to unlock the potential of AI, and it's a really exciting journey. So happy to do whatever you need. So feel free to reach out to any of us, and thank you for your time and interest.
Thank you.
Thanks,
Thank
guys.
you.
It's a pleasure.
Good evening.
Bye.
Bye. Bye. Cheers.